Hi, I'm Daryl Mazo with the law firm of Teeple in San Diego, California, and this is the third part of a four-part series about how companies successfully raise capital. If you missed the first two, you can find them on our website. So far, we've covered topics including an intro to the process, the different types of capital, and we started digging into the SIM, the investment business plan. This week, we're going to finish our discussion of your investment business plan before concluding next week with how to move forward with your own process. In our last visit together, we finished off with a discussion of the industry and your place in the market. This week, we're going to pick up with the two remaining parts of the SIM, and both are really important. Let's start with the people. I feel like I've beaten this point to death, but for my own enjoyment, I'm going to continue. Investors invest in people. They have to believe that you and your employees are the right horse to bet on, not literally, because it's not a bet, it's not a gamble. But there are lots of companies and lots of products and lots of services, and maybe they're exactly like yours. So what are you and your employees doing differently? What are their backgrounds? How long have they been with the company? So make sure to put in brief bios of key management team members. How many employees do you have? Are you unionized? What's the average tenure of your employees, and what's the turnover rate? Maybe you want to put in an average hourly rate if that's an important fact. I'd also include an organization chart. It really helps to see a picture. We've really addressed these points already, but if they're relevant, put them in your discussion. Maybe there are some other important pieces of information that are particular to your business that you can include, maybe in addition to or maybe in place of some of these things. Okay, big time stuff here, the financials. Why is this important? You really don't need to ask, do you? After going over all of the other information you spent hours putting together, it all boils down to this, the numbers. You may still be asking why. Well, I know you've heard the expression, a picture is worth 1,000 words, right? The financials are just that. They're a picture. You told a story about your company, but the financials are the evidence. You said that your company is doing well and has been. You said that your company has been growing and is more profitable today than it was 2 years ago. You said that your cost of goods sold has come down and your gross profit has gone up. The financials will show all of this in a way an investor can see really quickly. Not only will it show what you've done, but you'll be providing projections so an investor can see how you think your business will do in the future. I'm sure I'm going over things you already know, but for my own peace of mind, let's just review quickly what the financial statements are. First, there's an income statement. Many people refer to it as a P&L, meaning profit and loss. That's because this statement shows what profit you made or what loss you had. It shows the total sales, it shows the costs were to generate those sales, it shows what your infrastructure costs were. If you think about it, it shows how your company is a living, breathing organization that constantly moves and changes. Next is the balance sheet. The balance sheet shows what the company owns and owes. The assets are things like cash and what your customers owe you, what inventory you have on hand, what equipment and machinery you own. But it also shows how much debt you have. You probably owe vendors that you use to purchase inventory or services that you use to sell your goods and you haven't paid them yet. Maybe you had to borrow money to support the company or to purchase that inventory or machinery. All of that is here. And if you're profitable and have been profitable, you have a lot more assets than liabilities. And conversely, if you've been losing money, you may have more liabilities than assets, which is not a good place to be. In both cases, the difference between your assets and your liabilities is your net worth, meaning how much equity or ownership in your company is really worth. But don't confuse this with how much someone may be willing to pay you for your company if you ever want to sell it. It really means that if the company were to shut down and you had to sell all of your assets and pay off all of your debt, this is how much money would be left to put in your pocket. The last of the financial statements we'll discuss is the cash flow statement. It's just as it sounds. It shows all the cash being used by and being generated by your company. If you put the income statement and the balance sheet together, what you would really come up with is the cash flow statement. It reflects how much of your money you may have tied up in working capital, how much your capital expenditures are, what expenses on your income statement that weren't cash related, etc. What is it you're really trying to show here? I think you have a pretty good idea. You're trying to give a very accurate picture of how your company has performed in the past, how it's performing now, and how you think it's going to do in the future. When we talk about what you should provide, these slides are pretty self-explanatory, but I do want to emphasize a couple of things. First, give detail. Don't just list sales and profit. That by itself really doesn't tell anything. Give line item expenses and define categories like maybe administrative salaries, G&A, taxes, depreciation, things like that. Second, provide monthly financial statements with a total for the year. And third, try to provide 3 years of historical financials with each year on a separate sheet or an Excel tab. Similarly, with year-to-date financials, provide the same level of detail. Do it monthly up to the current month with a total column as well. Lastly, projections. It can be really hard to come up with some good projections, particularly for several years out, but that doesn't mean an investor doesn't want to see them. A shrewd investor is going to look at the past and the future all together and try to calculate what return to expect at the end of the investment period. Try to provide 5 years projections if possible, with the first year being monthly. You should have a pretty clear picture of how the company is going to do on a monthly basis for the coming year. But for latter years, most likely that's not very accurate, so don't guess, but be able to provide a forecast on an annual basis. Lastly, if your business is capital intensive, meaning you have to buy lots of machinery or fleets of trucks or something like that, then put in a capital budget for each of the projected years. Don't just include dollars, but what those dollars will be spent on. Once you've put together the financial statements, it would be a good idea to write down some bullet points or short paragraphs that discuss key elements of your company's financial performance. These things would include any significant reasons for changes in performance, like, as we described before, losing a contract, or the price of materials went up, or maybe even that with all the competition you had to drop your price to stay competitive. And don't forget to give really solid assumptions for your forecast. Why would sales be increasing? Do you have new contracts in the pipeline? Why is the cost of sales going up? Do you have an increase in your labor cost? An increase in pricing with your outsourced service providers? Make sure to provide all of these assumptions. Believe it or not, we are almost done, so just hang in there for a few more minutes. The last thing that I want to discuss today is telling the investor what you're looking for and why. Try to give a concise but complete description of what type of capital you need. Is it equity? Is it debt? Tell them how much you're looking for and on what terms you expect to provide. Like if you're raising equity, how much of the company you're selling. If you're raising debt, how long do you need the money for? What's the plan for the money? Is it for growth? Is it because of growing working capital? Do you want to take some money off the table? Just try to be as specific as you can. Once you provide that information, just like with the financials, put together a sources and uses of funds statement like the one you see here. You gave a description, now give a picture. Does that make sense? The two topics we covered today are important ones, so please do your best and don't skip over the details here. Glossing over the financials can really be a red flag to an investor, and not providing details regarding the management leaves a big hole in your story. I know I said all of this last week, but here it is again. There's a lot that goes into putting this document together, but like we discussed last week as well, it's your first and your best opportunity to tell the story. The information that goes into this document are things that you should know, and if you don't, you need to, because an investor will definitely want to know the answers to these questions. So be prepared and know the answers to the questions before they're asked. Next week, we're going to finish up our discussion. We'll talk about the rest of the process, and steps you need to take to close the deal. Until then, this is Daryl Mazo with the law firm of Teeple Hall, and I do hope you'll join me again next week for our last discussion.